Your bank doesn't charge you $15 a month because it costs them $15 to serve you. They charge you $15 a month because you don't have enough money to make them stop. I used to build the spreadsheets that tracked this. Sat at an analyst desk watching low balance accounts get flagged, not as problems, but as profit centers. The less you had, the more you were worth to us. Not despite the small balance, because of it. That math hasn't changed. What changed is the one federal rule that was about to cap it just got killed in May. So now, it's on you. Here's exactly how the fee machine works, and the two moves that get you out of it. The first scam is the simplest one. The less money you have in checking, the more that checking account costs. At a lot of big banks, $15 a month is basically the new standard. Chase total checking is $15. Wells Fargo everyday checking is $15. That's $180 a year to access your own money. Not to earn interest, not to get a perk, just to exist in the system with a balance that doesn't meet their comfort level. They call it a monthly maintenance fee. That's branding. It's a minimum balance penalty dressed up like a service charge. And it's not inevitable. Bankrate's 2025 data shows 47% of non-interest checking accounts are fee-free. So when a bank charges you $15, that's not the cost of serving you. That's a business decision. Also, $180 a year isn't small leakage. That's groceries. That's your phone bill. That's a utility month that didn't go sideways. And over 5 years, it's $900 for the privilege of being low balance. Now watch how they make avoid the fee sound easy while designing it to be hard in real life. The waiver rules aren't random. They're tuned to normal cash flow stress, where you're doing fine until one bill hits before one deposit. On paper, they sound reasonable. Chase says you can avoid the fee with a $1,500 daily balance, or $500 or more in direct deposit per pay period, or $5,000 in combined balances. Wells Fargo is sitting in the same neighborhood now. $1,500 daily balance, up from $500 starting October 2025, or $500 in direct deposit per month, or $5,000 combined. Bank of America will sell you Safe Balance with a $500 daily balance requirement, and then their relationship tier jumps to a $20,000 daily balance. That one's almost performance art. The killer word is daily. Not monthly, daily. You can do everything right, but if rent clears 2 days before payday and your balance dips for a few hours, you're done for the month. I remember 2007, paying rent 2 days before payday. My balance dropped under $1,500 for maybe 18 hours. Full fee anyway. And this isn't some edge case. A PNC survey says 67% live paycheck to paycheck, and under $50K it's 72.8%. Median checking balance for households under $20,540 a year is about $300. Now tell me who this free checking is built for. Let's do the math they're hoping you never do. Say you keep about $500 in your checking account. What does the bank actually earn on you? Industry net interest margin was about 3.39% in Q4 2025. On $500, that's roughly $17 a year. Now compare that to the maintenance fee. $15 a month is $180 a year. So the bank can make about 10 times more charging you for having less money than they make from your money sitting there. And when they tell you it costs money to serve accounts, sure, but not like that. A branch transaction is around $4. Online is about 9 cents. Mobile is about 19 cents. They've been closing branches at scale, about 1,646 closures a year since 2018, while digital transformation cuts operating costs by 20 to 40%. Costs went down, fees didn't. They don't need this to survive. JP Morgan made $58.5 billion in 2024. Wells Fargo made $19.7 billion. Overdraft revenue alone, about $1.028 billion at Chase, about $1 billion at Wells. I ran numbers like this at my desk in 2006. Took me longer than I'd like to admit to understand what I was looking at. This isn't cost recovery, it's margin extraction. If this is the kind of math you wish someone had shown you years ago, subscribe. That's how more people see this instead of another bank ad. Now, What was supposed to change this year? In December 2024, the CFPB finalized an overdraft rule that was aimed straight at the fee mine. For banks over $10 billion in assets, it would have done one of three things. Cap overdraft fees at $5 instead of the roughly $27 people were paying on average, or force the bank to price the fee to the actual cost, or treat overdraft like credit and make them disclose it like credit, APR and all. Real numbers, real accountability. Their estimate was about $5 billion a year back in consumers' pockets. Roughly $225 per fee-paying household. That's not nice. That's groceries. That's a car repair you don't have to put on a credit card. Then, on May 9, 2025, a Congressional Review Act resolution was signed after a 219-211 House vote. The rule got overturned, and the CFPB can't issue a substantially similar rule without new legislation. So the direction was clear. Stop turning everyday banking into a fee machine. That protection is gone. Which means the practical move is opting out yourself. And I'm curious, comment if you got hit with one of these fees in the last year. Or if you ever got one reversed. Worked, didn't work, I read them. You're not calling to beg. You're calling because banks build discretion into these fees, and they use it when it helps retention. Here's the exact line. I'm calling about the $15 monthly maintenance fee on April 3rd. I want a one-time courtesy waiver and a reversal. Then stop talking. Let them answer. If they say no, don't argue. Say, can you transfer me to a supervisor or an account specialist? If that still goes nowhere, end it politely and call back later. Different reps have different discretion. That's not a conspiracy. That's how call centers work. What triggers the internal logic is simple. How long you've been a customer, whether you've had direct deposit, whether you have another account there. And this sentence, calm and clean. If it can't be waived, I'm moving my direct deposit and closing the account. While you have them, lock it in. Ask for written confirmation in the message center. Ask if there's a cheaper or no fee option. And ask, what exact requirement avoids this fee? Then check if your real cash flow can actually hit it. Bankrate says 95% of fee-charging accounts have a way to avoid the fee. Banks mostly rely on you missing it by accident. I called last month to get one reversed on Dana's account. 4 minutes. Done. Most people already know they should switch. The reason they don't isn't laziness. It's this. They stay because switching is annoying. 63% of people say the direct deposit and auto-pay hassle is the #1 blocker. And banks know that. Inertia is part of the product. So don't get motivated. Use a checklist. Step 1. Open the new account, credit union or online bank, and fund it small. $20, $50. Just enough to make it real. Step 2. Move income first. Direct deposit. Then move bills. Pull your last 6 to 12 months of statements and write down every auto pay and subscription that hits that account. Don't trust your memory. Your memory is how they get paid. Step 3. Keep the old account open about 2 months as a buffer. Then close it only after everything clears. And get the closure confirmation in writing. Auto pays can still try to hit after you close, and some banks will happily reopen your account to collect a fee. Also, closing a checking account doesn't affect your credit score. Experian's been clear on that. What to switch to? Credit unions and banks without monthly fees and gotcha rules. Alliant is no monthly fee, no overdraft fees, and a big ATM network. SoFi is no monthly fees, pays interest, and does early payday. Connexus has a fee-free option and higher APY if you meet requirements. My dad's been at the same credit union in Columbus for over 30 years. Never paid a maintenance fee in his life. That's not discipline. That's the right product.